And a big welcome to our live audience for the Digital Health Investment Talk show. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at x.com/Stephen Wardell. Our show today is on the topic of investor themes for the new era, and our guest today is Amir Dan Rubin. Amir is the CEO and founding managing partner of Healthier Capital, a venture capital firm focused on technology-powered healthcare innovation, and he's the former CEO of One Medical. This show is being recorded and will be included in my podcast series called the Digital Health Investor Talk Show. You can subscribe to our podcast on Apple and Spotify, and please leave us a review. We always love getting 5-star reviews. We have new podcast links for the shows, so make sure you see recent episodes on Apple Podcasts and Spotify when you subscribe, or you could be subscribing to the old podcast page. This is not investment advice, and we are not investment advisors. Here's the format of today's show. It's 90 minutes long, and Amir and I will spend the first part discussing the macro picture and trade journal news and other topics, and then we'll focus on our special topic of the day. And we'll be taking questions throughout the show in the LinkedIn chat. Amir, welcome to the show, and please introduce yourself to our audience.
Stephen, it's great to be with you and great to be with the audience. Hi, everybody. Amir Dan Rubin. As Stephen said, I founded and am a partner at Healthier Capital. We're a venture capital firm investing at the intersection of technology and healthcare software and services. Also, as Stephen mentioned, prior to Healthier Capital, I was the CEO at a modernized primary care, tech-enabled primary care company called One Medical, which we took public in 2020 and then later on sold to Amazon. And I spent a year lifting boxes at Amazon prior to launching Healthier Capital. Prior to that, I was an executive vice president at Optum. And before that, I was CEO at Stanford University's health system in Palo Alto, where I still live, a COO at UCLA's health system in Los Angeles, a COO at State University of New York, Stony Brook's health system. Then I was at Memorial Hermann and other places before that. And after I had grad school before that, and before that was involved in a startup building software. So great to be with you, Stephen, and so great to be with the audience.
Thank you. And that's a great perspective for the several issues we'll address on today's show. So first, we'll take a look at macro issues. And last I checked today, the NASDAQ is sliding down, and it's at 17.9 thousand. That's the last couple of weeks. It's gone down a few percent, and it's sort of continuing a losing streak. And I think this reflects Wall Street's concern over a number of things. One is that we may have had a recession that was delayed by war spending, and now we may see that recession be manifest, and recessions usually lead to the pull-in of valuation levels. This is related to what I'll call fiscal austerity. So this is federal fiscal austerity, not so much spelled out that way, but if they succeed in $1 trillion of federal spending cuts, then that will be effectively a form of fiscal austerity, which usually helps contribute to a recession. Then there's the uncertain tariffs and the possibility of a trade war. The trade war, usually viewed as not a great thing in and of itself, but can also be inflationary. And then the specter of war, peace, possibly a greater war or failed peace in Ukraine and the Middle East. And then also, interestingly, I think there was, for a while, people have pointed out that when you look at the S&P and the NASDAQ, they're very heavily weighted toward big tech stocks, which in turn have had a positive AI story about the future that has led to lift. And a lot of the market lift of the last year or two has come from the biggest tech stocks promising a better future through AI. And we're seeing a little bit of a deflation around that, which could be in part because China has published AI models and made them open source. That indicate that having a proprietary AI model is not enough to get you an outsized return long term. So those are some of the interesting issues. And in general, the world of digital health and the innovation economy is all about growth, achieving growth as a young company and having that recognized in valuation markets. And so going into a recession and having stock market values pull in is generally not a good thing for the digital health economy in general. But if you found a pain point to solve, it can mean that as an entrepreneur, you have less frenetic competition around you of other entrepreneurs for a while. But in general, we tend to want the stock market to be risk off and recognizing growth companies and that sort of thing. So, Amir, any thoughts on current market conditions and what the last 2 weeks of the stock market performance mean for the innovation economy of young company leaders and investors?
Well, maybe I'll just start and say I think at some level maybe we're underhyping the impact of AI. And so, as a venture investor who's thinking over multiple years and maybe even a decade as a fund cycle, I think the opportunities here are going to be huge and significant. Certainly, there's uncertainties, as you mentioned, in the macro economy. There could be also some things that are reduce the budget, reduce spending that may be facilitative towards long-term interest rates coming down, which actually haven't come down that much, even as we've seen short-term rates come down. But I think if we look over a medium term, I think the opportunities with AI, and particularly as we bring that into healthcare, are tremendous. And I also think over the next weeks and months, we're seeing CMS and the team come into place in the leadership side there. And I think we'll see stability, more stability in terms of what's happening, particularly on the Medicare and Medicaid side. I think we'll have a facilitative environment in terms of AI and AI environment for startups, both from the market perspective in terms of technology, as well as I think from the regulatory perspective. So I'd say, at least as it applies to healthcare, I think there's a lot of tailwinds. Certainly uncertainties around Medicaid funding and spending there. I think probably reasonable scenario on the Medicare side, and probably continued plus or minus in the current environment as we are on the commercial side. So I actually think all of that put together, I think positions health tech in a pretty good way.
Really interesting. Thanks. And I see it's often helpful to look at the world of B2B to figure out what's going to happen in the world of digital health. And in B2B, you're seeing entrepreneurs say they're going to rebuild every piece of B2B software using AI to help with coding. And then they'll have a lower capital cost of code base and be able to charge less, and also add feature functionality because of the use of an AI engine in the product's feature functionality as well. And what I've been hearing is things like one product is what I call next best decision and next best action. So it tells the user who may have a low level of training what to do based on instantaneously analyzing all the data in the database, something that would have taken a more experienced decision maker longer to do on their own is just presented as the next best action. And then also the frontier is tool use. So now your AI software is not just one tool in front of you, like an Excel spreadsheet, but it can use other tools, so it can purchase something for you as well, if that's the next best decision. Those are some interesting, it's an exciting time to be the entrepreneur or the investor, because you have these opportunities to invest today in companies that have these greater capabilities.
Absolutely. And we're already seeing that, and we're seeing it in the marketplace. To give an example, one of the companies we're invested in, Hyro, Hyro, this is a company largely selling into health systems to automate the contact center. So people message, they call, and it's hard for health systems, frankly, to hire enough people and to respond in a timely fashion. This is using AI agents to respond either in voice or in messaging, or you could go from message to voice. Instead of all those sticky notes on the screen, the system knows the answers. And they're getting great traction in some major health systems, answering 60 to 80% of all the questions, including all the way through scheduling, interfacing with the EHRs, the Epics, the Cerners of the world, interfacing with the interactive voice response systems. So here's an example where demand is high, hard to keep up with the calls, hard to keep up with labor, and where AI agents today are working at scale. So yeah, this is here, and I'd say it's going to grow significantly.
So another macro issue is that the Fed had their meeting last week, and they chose to maintain the federal funds rate at a range between 4.25 and 4.5%. And that was a disappointment. I know the Fed had signaled months ago that it would make multiple cuts and it has since sounded, and that's aggressive, and they've since sounded less aggressive, like they're not sure inflation has been beat. And in the innovation economy, we definitely want to hear that inflation has been beat, but because they're not sure inflation has been beat, therefore they're not ready to cut rates further. And I think that was disappointing. So high rates means that you don't value the future very much, and growth companies are very much all about earnings in the future. And low rates means that everybody has a choice between getting no return on bonds versus investing in growth stocks that give them a return off in the future. So we were hoping to see the federal funds rate cut more. Any thought on the Fed, and will we see more rate cuts this year?
Well, first, if you look at kind of the Fed dot plots and you map these things out, there still are penciled in, it looks like 2 cuts in the year. Also, some would have said the Fed cut before the election, and if you remember, a larger cut was maybe not what we should have done, because there aren't necessarily signs the economy is slowing. Actually, producer index just came out, looks good. Slight improvements in CPE and CPI. Different metrics of inflation. So labor market's holding, wages are holding, certainly uncertainties around tariffs and what that does on costs. But I'm not sure we're in a different scenario really than we were a few months. I think there's more uncertainty on trade policy, but otherwise we're pretty much in my opinion, in a pretty similar scenario. And maybe, as I said, we might have a little bit more focus on debt and deficit reduction in spending. We'll see. We might not, which is would be supportive of bringing down long-term interest rates. Those are some perspectives, I'd say, on the macro, on the Fed. In the scheme of long-term thinking, we got used to a zero interest rate environment, which was awesome if your cash flows are way into the future. But at some level, having Fed's funds rates at 4.25 to 4.5, and maybe they come down a little, is not, not a crazy level. Certainly, we'd like to see those come down, and we'd like to see inflation keep marching down towards 2%. And maybe some people say that's not the natural rate of inflation. Maybe it's slightly higher. But I'm not sure we're in a fundamentally different environment. There's a lot of uncertainties, global uncertainties. There's a lot of trade uncertainties now, but I don't think those are fundamentally changing the investment thesis.
Thanks, and for our audience, feel free to ask questions in the chat as well. So I thought I'd move on to some business and trade journal news here. So the first is I'm hearing of kind of what I'd call a Trump pause, and that is that investor activity level is lower today than it was during the ZIRP period, the number of deals being done. And the Trump pause is that there's so many new areas of uncertainty, whether that's tariffs or priorities of HHS spending or other things like that, that some investors are just sort of stepping back. So Trump's been president since January, and some are stepping back for a few months to sort of see what's going to happen to see how others are reacting to this. So that's that's concerning to young company leaders who are hoping to get out there and raise money. Have you been hearing this, or do you think that investing is sort of at the same level now as it was 3 months ago and 6 months ago?
Yeah, that is not what we're seeing or experiencing. And I think there's a lot of tailwinds out there now. Certainly, we're seeing a lot of enthusiasm around AI and what it can do in healthcare, given the problem statements in healthcare. And as you mentioned, we're seeing a generation of companies now coming up that are kind of AI first. And we could talk about some other ones that we're involved with and other ones in the market that there's a lot of enthusiasm around. And I think we're seeing venture activity pick up, and certainly pick up in those exciting areas. I also think the folks that are already in CMS and nominated in CMS are known to us in the industry. And so I think from a CMS perspective, I think we'll be in a pretty good spot with a lot of continuity of thinking, which frankly we've seen across administrations, really. Kind of a general movement towards value-based care, a general movement towards more data, a general movement towards more innovation models. So I think all of those are in general quite positive. Certainly some uncertainties still as these things play out, but I'd say in the venture world, pretty exciting. I'd also say we're seeing maybe a pickup in M&A activity and a presumption around slightly more accommodating, if you will, FTC and DOJ approach. We're already seeing some M&A activity in our world in earlier stages. You've seen some recent transactions announced. You're starting to see some IPOs announced, and we could get into those. Some are flipped public. So I, in general, am feeling pretty good about the environment for health tech.
That's great. I like what I hear, and I think your voice is one of the more optimistic voices we've had, which is great. So then also, I think the people were very excited to hear about Hinge filing an S1. So Hinge is a top musculoskeletal care management company selling into the employer and payer markets, and they filed an S1 on March 10th, and and people were very curious to see these numbers. So Hinge is roughly older than 10 years old. And so what do the numbers look like for a company? We get a lot of companies sort of bragging when they're private and no one knows their numbers. But what does it look like when they finally put up an S1? And the answer was top line growth rate historic of 33% and gross margins of 77% and turning earnings positive for the first time, I think, last quarter. And I think my impression is those are pretty good numbers for a company that's going public. And so initially, this was seen as a really good sign that this would be followed by this would likely be successful if bankers were taking it out, that it would be followed by other IPOs. But since then, it's been met with greater stock market volatility since the S1 was published. But I think we really want to see them successfully go public and the price to go up in the market after it goes public, and then more unicorns file. Any thoughts on the Hinge S1?
Well, kudos to the Hinge team for the great work that they're doing. And at the core, some of the statistics you mentioned are really impressive. So that's the business. Then it's very hard for a company, a team to address, what's happening in the market that day or that week. I remember when we IPO'd One Medical, it was January of 2020, and the market was down that day because they said, gee, there's this bug coming out of China that might hurt supply chains. And we're like, oh, crud. But, we couldn't pull that. And then later on, people said, well, you know what? Maybe digital health and physical sites could be useful for remote care and testing in vaccines and the like. So I think at the core, it's about the fundamentals of the company. And if you have a good company that's performing well, then it's a decision of how do you finance growth? Do you finance it more in the private markets? And at some point, the public markets may make more sense to finance a company. I think it's an encouraging side. I think the performance numbers are very encouraging. So kudos to the team there. And, I don't think one can overread what happens in a certain day or a week. But I think if you play this out, is there a big problem statement there? Is there a big demand? Do you have performance? Do you have evidence of consistent performance? In the public markets, it's really, can you perform consistently each quarter, right? That's one of the big things moving from a private to a public company that certainly I realized is you now need to hit performance each quarter and ideally exceed it and ideally guide to exceeding it. So one has to get to a level of consistency to really perform well in the public markets. So kudos to the team there. But I think underlying this, you're seeing a business that's performing reasonably quite well.
And have you heard any other sort of chatter about other S1s or IPOs? I know there's a list of over 50 digital health companies that meet the criteria of unicorn that have had capital in them for over 8 years, and the existing investors have got to be thinking of liquidity.
Yeah, there's a numbers that have filed privately, confidentially. So Hinge last week flipped to a public, filing, meaning it's gone out. These companies have the option to file first confidentially, and then they can with the SEC, and then they can flip it to a public stance. So I think a lot of them, and this is frankly not unique to healthcare, right? There haven't been a lot of IPOs, period, are looking for the right windows of time in the IPO market. You talked about some of the macro chop out there. Again, I think over time, that doesn't matter so much, but you would like to have, a good first day of trading and first few days of training. So you get your kind of sand underneath your shoes here. So yes, I think there are more out there, but I think that's the market environment is less unique to healthcare and health tech per se than any IPOs. And some of it also is driven by, do you need to raise more money? And what's the best way to raise more money? I personally don't like to think about going public as a per se a liquidity event. It's like, oh, we're done, we're out. It's really the next stage of how do you grow a company. And there can be also some value in having a stock and being able to acquire things with stock, if that makes sense for a company. It may also be a way to get a broader investor base. It may also be a lower cost of capital. There's new costs with being a public company in terms of tracking and accounting and finance and reporting and legal requirements. But yeah, I think we will see more. Certainly one of the bigger IPOs in the last year was a healthcare one, Waystar. We had R1, which was taken private in a $10 billion take private, but that was a public company. And we've seen some others that have actually traded reasonably well. So I think we will see more.
And so you mentioned consolidation. That sector that Hinge is in, I call it the employer health tech sector. This is the sector that includes Teladoc and includes Omada, and they sell benefits like telehealth or wellness or care management or other benefits into the employer health budget. And there's a lot of eyes on that sector for possible consolidation because the buyer is more mature and they want to buy suites and not just point solutions. And now Hinge is public. And so Hinge becomes a contender if it can get stock price up to be one of the acquirers in the sector, along with Teladoc and along with other companies that have done some acquisitions. So there was also, you had Virgin Pulse merged with HealthComp to form, I think it was Personify in that sector. So we may see further consolidation in that sector, which would be good for the sector as well, because there's a lot of companies that would like that, where buyers want to see suites, and so consolidation can play into product buyers getting suites, and then a lot of young companies would like to exit or become part of suites. So as well. Well, we have some questions from our audience actually that is about what is happening with funding of basic research, it looks like. And this affects biotech, but also other areas, and the possible interruption of funding or change in funding there. And so I think the view I have on this interruption and change in funding by the administration of basic research, science, innovation is that the way this often works is that first you have government funding of basic research, and that is funded for years along consistent themes. And then you have the fruits of that research, and then commercial companies can come in and license that in and form biotech companies or other companies in healthcare as well. And so I think with RFK in charge, you're going to see a change in the basic themes that they're funding. And this could create a gap. In other words, if they shift from funding one theme of research to a different theme of research, then you'll see a gap measured in years, 5 years or more, before that basic research starts producing the commercializable research. So, and then one of the questions we had here is there concern that leading US researchers will leave the country for Canada, Europe, and Asia, given cuts in research? And any thoughts on what this means for biotech investments, given some of the changes at NIH? So not quite digital health as a topic, but just do you have any thoughts on what you've seen announced and what it means for the future?
Sure. So I've been spending time with a lot of my academic medical center colleagues. I worked at 4 academic medical centers, as I mentioned in my bio. Just this week had dinner with the dean of a very prominent school of medicine, and we've been talking about all these topics. So I'd say a few things. First of all, one of the things that people are talking about, certainly in this academic world, is NIH funding, and particularly what's called indirect funding. And so there was a push as part of the DOGE effort to say different institutions have different add-ons to the direct grant for indirect. Why are some at 15% and some at 80%? Let's just put everybody at 15%. So there was actually some lawsuits filed against that, and there's been some stays or injunctions on that, and we'll see where that comes out. And basically the concepts there is, when you're doing research, including basic research, you need infrastructure, buildings and the like. And so that's what the indirects were supposed to. Is there opportunity to be more efficient in some of those indirects? Probably, possibly. Could those things be funded differently? Can they be more direct? Sometimes when grants are written towards industry and pharma, they're actually funded in the direct. Hey, I'll pay for a portion of this lab, or I'll pay on a per use basis. So that's in process now. We'll see where that ends up. It's certainly a risk and a risk of uncertainty for clinical researchers. there probably is some opportunities to redesign how that works. Net a cut can be a cut, but that's what's happened. In terms of the core NIH funding levels, those have not been proposed to change yet. Still under a budget resolution that, if you will, put forward last year's budget. That's kind of what happened in this continuing resolution approach. And ultimately what happens to NIH and other kind of research funding hasn't been determined, but there hasn't been major calls to cut it. I think what there have been explorations on is, how do we give these grants today, and do the same people always get the same grants? And so there's been evaluation there. We currently in these NIHs, you get groups of experts, study sections, and they review. And so some of the thought is, well, why do we get the same people to review the same things and give the grants to the same people? Maybe we should expand that view. And so I think we could see some changes there. I do think I certainly believe that our health research is one of the strengths of our country. It is one of the places that we can differentiate, and we should keep it as an advantage. And I think people recognize that as well. So I think there's uncertainties. Uncertainties are never great when you're trying to plan in terms of hiring and build buildings, and have graduate students and faculty billets of new hires. So that's certainly causing some pause and some consternation. But I'm not sure. I'm not sure it's necessarily all negative, and it's not necessarily the case that we'll see reductions in that overall baseline funding. So that still is to play its way out. And we may see greater access to these grants to more people, and maybe even more interesting grants. Often today, you'll see somebody get an initial grant, and then they'll file a bunch of stuff in the same area because they can basically win follow-ons more easily. But that may not be the most breakthrough kind of research. It's just the ones that you can get the easiest. And so it wouldn't all be bad to say, hey, let's maybe fund more breakthrough or riskier things, or things that are not as obvious. So again, there could be some interesting opportunities in there.
Great, thank you. Really interesting. So now I'm going to try to quickly go through just some trade journal news. So one thing, people are calling that we're now seeing the end of what I'll call the Biden moratorium on large tech M&A. So this was led by Lena Khan, who seems to have blocked a lot of large M&A deals. And then a few weeks into the Trump administration, we have Google announces the acquisition of IT security firm, the Wiz, for $32 billion. Really interesting. This is a company, I think it has top line growth of over 100%, which is astonishing. And this size of deal is Google's biggest ever deal. And people are pointing out that this helps Google sell into other enterprises it hasn't sold into yet, because the Wiz was selling to large enterprises that were not yet Google customers. And so that seems to indicate that fears that Lena Khan is going to block your deal are sort of subsiding, allowing for exits. I think Wiz is also less than 5 years old, which is just astonishing that they could grow to be so large and be acquired for so much in such a short period of time. And then also we saw Walgreens acquired by Sycamore Partners in a deal buying the equity for $10 billion, and then the total enterprise value, including debt, of $24 billion. And the pharmacy sector seems to have been troubled for quite a while. I think Rite Aid went bankrupt, and pharmacies pulled out of primary care, which was they got into primary care, then pulled out of primary care. And so it's interesting to see Walgreens bought by private equity, and also bought for substantially less than 5-year-old Wiz was bought for by Google. And so any thoughts on what we're seeing with these acquisitions, Amir?
Yeah, well, I think a few things. First of all, I don't know if we can ascribe the change on Google and Wiz to a regulatory environment. It certainly may be a more favorable environment now for. It may have also just been a good tactic. Wiz went from a assumed offer before, if you may remember, from Google at $23 billion, now to $32 billion. So, they waited a little and got 50% more. That could have something to do with it as well. And a great set of entrepreneurs out of Israel and in the cyber area, and had other great companies come from there, and now in the US. So, I think part of that is technology innovation. Part of that is pretty attractive price. Kudos there. And again, not an area of deep expertise of of mine, but certainly having been at Amazon, AWS, and then certainly Microsoft on Azure and Google are the big cloud players, with Amazon being the largest one there. So not surprising that Google's trying to do some things to build up its presence in the cloud support area, and cyber is an area that's of increasing importance to every sector. In terms of Walgreens, different scenario as well. You see CVS, which was a retail pharmacy, going back now a number of years, did something quite massive. I think it was an $86 billion acquisition / merger of Aetna. And then CVS through the years added on some care delivery assets, including Oak Street and Signify. So really took itself from a pure retailer to a retailer plus an insurance arm with commercial, Medicare, Medicaid, a pharmacy business, and a PBM, a CVS Caremark, and care delivery assets. Whereas Walgreens really doesn't have all those components, right? Have an insurance component, a pharmacy benefit management component. If you remember going back years ago, had some head-to-head battle with Express Scripts and was out of network for a while. Before that, went to Cigna Evernorth when Express Scripts was pulled out of Merck. They found themselves with 9 to 10,000 retail outlets, but without the kind of components that you see in, for example, a CVS, or you see it in United and Optum, which doesn't have the retail components, but certainly has pharmacy benefit management and insurance and clinical care delivery components. Say, it doesn't surprise me that they're looking to do something as strategic, and brought in new leadership who's been looking at how to do something as strategic. And sometimes it's easier to do these things as a private company than a public company. So sometimes taking private might be a better way to do some bigger changes. Again, as a public company, the investors are expecting consistency quarter over quarter, not massive differences and changes quarter over quarter. So sometimes it makes sense to be private versus public in terms of the investment community and financing community.
Great, thank you. And so then just a little more on the trade journal news. Sadly, 23andMe declared bankruptcy and the prominent CEO, Ann Wosicki, resigns. I know people in digital health have been following this company for a long time. It looks like, although it managed to create a good-selling consumer product, they had trouble figuring out how to become essential and prized by pharma, among other things. Any thoughts on this? Is this a story about how difficult it is to keep going a consumer company in healthcare, or any other thoughts on the lessons to be learned from the 23andMe bankruptcy?
Well, I think it's really hard to be a pioneer, and Anne was a pioneer in a number of ways. One, in direct to consumer. Two, in direct to consumer genetics. And really created something that actually, for a while, had high value. It was trading in the multiple billions. But so being a pioneer in a new field, in a new business, is hard. And then finding business models that have repeatable earnings can be challenging, particularly in something like genetics or genomics. I may not need to resequence myself, every year. And so what's the ongoing revenue stream? And she and the team were looking at, hey, we can maybe look at drug development and some other things. So, at some level, I would say kudos for being a pioneer and innovating in a challenging area. So, and when one is doing something in the venture world or the new startup world, as I sometimes like to say, risk is risky. These are blazing new trails. But do we think that better health outcomes are just going to be by the way we do things, or will we understand our genomics, our metabolism, our metabolomics, how our proteins work? Will we combine that with imaging? Right? Yes, we're gonna be doing all of that. The answer is probably, whoa, what is my morphology? What is my imaging? What does my anatomy look like? What do my genetics look like? How does my metabolism work? What are my activities like? What's my nutrition and diet like? So, at some level, I think we're at the beginning of more, if you will, precision health that includes genomics. I also think thus, in addition to the underlying kind of innovations, we also are evolving in the business models here. I'll just harken a little bit to One Medical. We created a subscription model for primary care. There hadn't been a subscription model for primary care. So we can have some ways to do longitudinal population health and engage people over time. I think I'm excited to see innovations and what 23andMe did here in terms of really pioneering a field, and I think we'll build on that and are seeing, frankly, in the private world, we're seeing companies building upon those lessons to say, okay, what did we learn here? How can we integrate even more information? How can we have more longitudinal data? How can we have lifetime relationships with clients, customers?
Great, thank you. So now I'm going to skip some sections just to keep us on track in terms of time. So one of our favorite sections here is just a technology that you use in your daily life that has improved your life. And so I'll bring up, in the recent past, I've been playing around with AI apps, and in the Grok app, it has a robust voice mode, a native voice mode, and this has sub modes, and the sub modes include things like assistant, a child storyteller, argumentative mode, and not a doctor mode, which is actually a doctor mode, and not a lawyer mode, which is actually a lawyer mode for it. So I just thought that was very interesting, and it got me using native voice AI chatting more to sort of have that filter and knowing what to expect from these different voices. So I like that. I think it's worth giving a try. ChatGPT app for iPhone and for Android also has very good native voice as well. Amir, any technology that you use that you want to tell our audience about that has improved your quality of life?
Yeah, absolutely. Maybe a few. I mean, just on the ChatGPT side, on the iPhone app, I have used the image recognition, take a photo of different languages, traveling abroad. You're taking an image, it's translating and it's reading it back to you. So I've used that abroad at night, shine my flashlight on a sign, took the picture, translate it, read it, which was extremely useful. Closer in the business, we're using kind of AI in our customer relationship management, how we are managing our investors and our companies in terms of analyzing our inbound messages, our tracking, when we need to follow up with people, and we organize. We have tremendous inbound, particularly as we look at a lot of companies. So it's automatically filtering and reminding us and saying us when we last communicated, and helps us sort things into buckets of this is inbound, this is initial review, this is secondary review. So these kind of tools are phenomenal. We're also using it in summarization of documents. And then one of our companies, Metaloop, is using agentic AI agents to help on analytics, clinical research. But I've been playing around with this tool. And so you can ask it questions from big data sets, complex questions, and it'll put together very sophisticated responses. So for example, say, gee, what's the connection between C-reactive protein and lung cancers? I'm looking at big electronic health record data. It will on its own say, well, Amir, to answer that question, let me set up a control group of lung cancer without elevated C-reactive protein and an experimental group with it. Let me look at the underlying data. I ran your data with and without some outliers. Here's a box plot of the outliers. I looked at the underlying distribution of the data and I noticed it was normal. So I compared the experimental and the control group. I did a two-sided t-test. I also looked at some of your past abstracts and papers, and I wrote up the results in your style. So this is some of the stuff where we're certainly working with researchers and life sciences companies who are procuring these tools, but I've been playing with them, and it's kind of remarkable. So the analytics, and basically what it's doing is it's learning from the various queries using kind of a neural network. But then these agents are writing Python and SQL code to write these queries, do the biostatistics, and summarize these things. So we're now approaching analytics in a different way. And so, and now we could use much, much bigger data sets. So from I'll say the mundane, I'm certainly using it, but also now in our business, but also for sophisticated, complex analyses that would have taken us weeks, if not months. We're using these tools in powerful ways.
Really interesting. Thank you. So next I'll move on to, we do little mini reviews of conferences here. So I'll mention a couple conferences coming up. So one of them is the BioIT World Conference and Expo. That's coming up in Boston, April 2nd to 4th. And I think this is probably the top trade show for BioIT companies. That's in the world of pharma discovery and early stage drug development. And so for young tech companies in that sector who sell into the pharma discovery and early stage development budget, this is the place to go in terms of finding VCs from Boston and New York, and also selling to your pharma buyers. So that's BioIT World. And then also coming up end of April is Device Talks Boston. This is a medtech and med device conference in Boston, and it's pretty well attended by New York and Boston VCs in medtech, med device. So those are two coming up, and I think that's the case for attending them. Amir, any conferences coming up in the next couple of months that your crowd is going to that you recommend as either trade shows or investor conferences?
There's all kinds of ones out there, and we're at a bunch of these coming up. Some teams at Health Evolution, some at Next Med, I think are the next ones out there. We were just at one in San Francisco last week in AI and healthcare. And I personally spend a lot of time with health system and health plan leaders directly. I'm in some CEO groups that have a collection of those. Those are really good, where you can kind of, in a closed environment, talk about what's going on. And then I spend a lot of time, and our team does at Healthier Capital, one-on-one. I was just with the CEO of another major health system. I was with the dean of another major health system, because there you can actually, today we were with one of the largest nonprofit health systems in the US on remote, but catching up on their issues. So we spend a lot of time connecting with the marketplace. As we started this call, we also spend time with the policy and regulatory folks. I sit on some advisory boards of some folks who used to be in CMS and FDA, and connect with folks that are currently and recently in there. So I think it's, in our field, very important to stay connected to what's happening in the market with the startups themselves, with the potential clients for startups. I just did a meeting with a bunch of HR benefit leaders back to the benefits purchaser space. So there's a number of these forums out there, and we try to stay connected to them.
And finally, before we get to our next section, just personal notices for the audience out there. I'm doing one of my health innovation nights coming up in New York, Tuesday, April 1st. So you can check out my Eventbrite page, stephenwardell.eventbrite.com, to get tickets. But we have Alex Fair and Ron Razmi are debating whether or not AI will replace your doctor for our health innovation night in New York coming up this coming Tuesday, April 1st. So check that out. Amir, do you have any personal notices? Are you going to be speaking on television or attending a conference and welcome people to reach out when you're at the conference or that sort of thing?
Sure. I'll be at Next Med next week. I'll be in Friday at a geriatrics conference at University of Southern California. I get around. Those are just in the next few days. A Health Evolution Summit, I'll be there in a couple weeks. PNC and Oracle are hosting an AI healthcare symposium in San Francisco. I'll be there in the next week. I'm at the University of Michigan on a health advisory board in the next couple weeks. I'm with the Duke Margolis Health Policy Group in the next few weeks, and they have a conference in DC coming up. That's super interesting. So that's just a smattering some of the things we're involved with.
And the Next Med Health. So for our audience, that's Daniel Kraft, who's one of the better futurists in digital health, and who used to run the Exponential Medicine Conference. And this is his annual conference. I think it's March 30th through April 2nd in San Diego. And this is where you can kind of go to see cutting edge innovation and professional education on innovation in healthcare and sort of recharge your batteries. So that's a favorite one that I have for sort of education and inspiration around innovation in healthcare. Well, great. Well, so now we move on to the main topic of our show, which is investor themes for the new era. What are the new pain points in the healthcare system? What are some of the themes that investors are betting on? And so, just wanted to get your early thoughts on, we're in a different era in a couple of ways. We have an AI technology shock, and we have the end of low interest rates for the sector. And the different budgets, like the payer budget, the provider budget, the pharma budget, they have different levels of feeling spendy or feeling risk-seeking on the one hand versus feeling constrained and risk-averse on the other hand. So what do you think are some of the big pain points out there that are attracting investor interest among payers, providers, and pharma?
Yeah. So to your points, I think to look at some of the problem statements or the cases for change, one can look at the, if you will, exogenous shocks or changes to the system. And you mentioned a couple: new technology, AI, policy changes, whether it's interest rate policy or healthcare policy. And then the other place one can look is kind of the core problem statements of the key stakeholders, which is often where I like to start, and we like to start at Healthier Capital. If you break up the world into kind of the demand side of healthcare and the supply side of healthcare, is often how I like to look at it. So when we look at the demand side of healthcare, we see, for example, consumers frustrated with access and their experience, long wait times to get in. And this is even if you have great insurance. We see frustrations from employers and payers on rising costs and medical inflation and waste in the system. And then we also see frustrations on the supply side. You see burnout in physicians and nurses. You see workforce shortages. You see administrative burdens, I call them the burdens of desktop medicine. And then you see health networks, health systems, health plans trying to coordinate care, and that being very frustrating. And that's happening in the face of an aging population. We're going to have more demand. We're going from about 16% of the population, or 54 million people in 2019 over 65, to 21% of the population and 73 million over 65 by 2030, which is essentially now, right? We're in 2025. So that's going to even exacerbate these kind of coordination issues. So I think you have the stakeholders, demand and supply side, looking for better access, lower wait times, more value, less waste on the demand side, and greater administrative and clinical efficiencies and addressing staffing issues and coordination of care issues. And then you have, on top of that, the kind of exogenous shock, and I'd say in a positive way, of what we can do with technology. And so putting that all together here in the blender, if you will, when I think of then key themes, and this is the kind of key themes we're investing in at Healthier Capital, on the demand side, we look at how do we improve that consumer experience and access through technology-powered solution for consumers. For employers and payers on the demand side, how do we improve care value and innovate clinical services? And then on the supply side, how do we address those staffing and labor issues with administrative and clinical automation? And for coordination of care and pulling things into health network, how do we leverage software and tech-enabled services? So these are some of the problem statements and the key themes that we see emerging in the health tech space.
So that's great. And I like the way that you broke that down into the demand side and the supply side as well. So we have a question from David in the audience who says, what's your take on utilizing Gen AI in the mental health space, particularly on the preclinical issues like loneliness and social emotional isolation? So do you see Gen AI as being, maybe we're talking about an app with a personality here? Any thoughts on that?
Yeah, well, we're invested in two behavioral health companies, one called Octave in the telebehavioral space in kind of anxiety and stress and depression, and another business, My Health, AMAE, in the serious mental illness space that's kind of a complex care medical home for patients post schizophrenia, psychosis, kind of discharge from the hospital. And I think we're seeing AI being used in both those models in a few different ways, and I think we'll continue to see them used. I think, first of all, there's an intake approach, right? So how can we convert interest into conversations? So even before thinking about using AI to do behavioral health, people reach out, they call, they inquire, they need appointments, they need to schedule, they need to book things. So there's all of that administrative coordination. And then we're using these tools now to automate that work. It goes back to something you said in the beginning. I think, frankly, every company is going to be doing this. We used to talk about, oh, this is a web company. It was a .com, remember? Or it's a mobile company. Well, everybody has a website, and a mobile engagement. I think we're going to see at some level the same here. These are tools that we're going to use. I think the best companies are going to use them in better ways, just like the best companies operated more effectively and efficiently, had a better user experience, had a better customer experience, were more efficient, right? So we're starting to see that. Do I then think we can use these tools to actually engage in the content of discussions and conversations? Yes, I do. I think thinking about how we do that safely, appropriately, within a regulatory environment, within a reimbursement environment, I think those are the things that one will need to think about. But certainly you already are seeing tools that can judge your sentiment, right? And can translate your words. And there's already folks that have developed avatars and the like to engage with people and actually create a persona. I think we have to be thoughtful and careful in a medical context, certainly around safety and from the company's perspective, kind of legal liability. But yes, I think we will see these kind of capabilities.
What you mentioned, so very interesting. There's a story about the way that we engage with computers that was told by James Fallows. He's a famous author who worked for the Atlantic Monthly for a while, a reporter. And he talked about how someone is in a position where they're saying, well, I need to do some calculations. So I need to get in front of my desktop and pull up Excel, and then I can do my calculations. But maybe I need to think about a calendar item for a couple of weeks in the future. So now I need to pull up somehow my calendar and get into my calendar. And then someone sent me a text message. So now I need to find my phone and open up the texting app on my phone in order to engage with them. And what I've heard that's very innovative recently is that maybe in the future, there will only ever be a single interface. And the single interface is talking to your phone. And so now you speak to your phone and it generates a spreadsheet in front of you to do your spreadsheet calculations. You speak to your phone and it tells you what your text message said and then sends a text reply to that message. So we may be converging on a future where and the fact that we have to be in front of a desktop in order to pull up Excel, or we have to have a phone with us in order to send a text message. This has been described as kind of a goo. There's a goo you have to fight through in order to be able to do what you want to do. But in the future, you may wind up having just one interface, and it is a voice-based interface, and it then opens up apps, conducts workflows in apps for you, and you don't have to do that yourself. You can be in front of your phone and not in front of your PC and still do work in Excel or that. So that's an interesting innovation out there. And then the second is among young people, one of the killer apps of AI is an app called Character AI. And Character AI is kids talking to AIs all day. And there's standard AIs are presented. The AI is a samurai. The AI is a philosopher or something. But then people are creating their own characters as well and putting them out there. So you can now choose, 3 weeks ago, someone created a new AI, which is an anime character, and it's very popular. And so you hear about it, and so you go chat with this anime character. And so we may have a future where young people drag us into chatting with AIs more for entertainment and also possibly for mental health.
Absolutely on both fronts. And I think, to your first comment, I don't think we're going to be limited to voice. I think it's multimodality. Sometimes it's voice, but we're looking at companies with computer vision, meaning monitoring patients in the operating room or the ICU or the floor. There's no voice. There's nothing said. I saw one the other day, a demo of a company, endoscopic surgery. The surgeon's doing surgery from the images, no talking, documentation was done. I see you sutured this, you lacerated that, CPT code this, not ambient listening. No, just from the computer vision. Right? So maybe you don't have to talk at all, Stephen. How about that? Just stand there and it can understand. I think it'll be a combination. And I think form factor varies. Sometimes I like to do things in voice. Sometimes, though, if you want to be prompted, it's hard to do that with just voice, right? So, hey, you're seeing a very complex patient. By the way, I've ingested all of the claims data from the past 5 years. This is something we did at One Medical, for example, for complex Medicare patients, and we'd show that in flow for a provider. I did see, I suspect the patient might have diabetes because I saw a metformin prescription 3 years ago. Is that something you want to consider? You may not want a voice just saying that. That may be a better form factor to see versus you may want to say, hey, help me with my documentation, use voice. You may want to use computer vision on that. And we piloted some of this through the years too, including back at Stanford when I was CEO there. Like, hey, let's put a camera to see if the patient's status has changed, right? So there's a lot of different technologies, a lot of different form factors. I think depends what we're doing. I think avatars can be good, and there's companies been using those in loneliness, using it with seniors, not just with children. We talked about behavioral health. So I think we will see multiple form factors, voice, video, avatars, if you will. But also we will sometimes a bigger screen format works, sometimes a smaller screen format works. Sometimes there's personal preferences. I think it's the ubiquity of it that will be powerful and how we can bring these tools together.
Thank you. Very interesting. And for our audience, now is your chance to ask Amir about issues like buyer pain points or investor themes or that sort of thing. So there was a joke at this year's JP Morgan. There was a joke that every healthcare story is a GLP-1 story these days. That you can sort of map this story in the Wall Street Journal maps back to this, which ultimately maps back to GLP-1s. But so are there any investor themes around GLP-1s? And here we tend to focus on the software side or the healthcare services side, not the molecule side. Obviously, someone with a better GLP-1 category drug, that's an investment opportunity. But how is that impacting traditional healthcare, tech-enabled services, software in healthcare? Do you see opportunities that are interesting and exciting around GLP-1s? For example, old diabetes programs may have to figure out how to freshen themselves in a GLP-1 environment.
Yeah, I think there's a lot of issues and opportunities. Stepping back a little bit, we have the whole challenge of cardiometabolic disorders, diabetes, and other related factors. And how do we address those as a society? We have more and more people who are pre-diabetic, diabetic, who have multiple comorbidities. And so how do we manage this? And we have an aging population. And GLP-1s are showing effectiveness on a lot of these chronic conditions as well as weight management. They also have some other side effects like sarcopenia, potential bone density issues, potential mass issues as you get thinner and less, frankly, strong over time as you age, what that does. So these are things that we'll have to look at over time. Back to musculoskeletal, probably demand for musculoskeletal issues as well. There's also a lot of interest in proactive health management at all age groups. We're involved in some AI and imaging screening company, Ezra, that's doing early screening for cancer. It's using AIs to reduce the time in scanner and find issues sooner. For example, there's no early screening for ovarian cancer, pancreatic cancer, brain tumors. MRIs can be pretty effective, particularly these AI-driven MRIs. Ezra can now do a full body scan in 30 minutes. They believe in the next couple of years can do it in 15. Or what if you can do just an ovarian scan in 5 minutes for $50? And track that over time. So I think we'll start seeing and continue to see innovations in how we can intervene in health and well-being. There's a lot of efforts around precision nutrition, things like creating a digital twin of oneself and running through, we talked about this before, my genomics, my metabolomics, my personal data, my phenotypic data, my behavioral data, and seeing what's the right nutrition for me. Different people respond differently to different food. Should I be on a high protein diet, on a ketogenic diet, on a low fat diet? Should I watch what I eat, when I eat it, what time I eat it? In general, the answers to this are yes, but the answers may not be exactly the same for each of us. So we're seeing a lot of interesting developments in this area, broadly impacting cardiometabolic, weight, health, nutrition, and all of these may touch around kind of the GLP-1s and the other weight management approaches. We've also seen companies in the compounding business doing these kind of off-label compounding and not. But we're seeing from the major drug developers next generation trials that some of these will be oral, or certainly movements towards that. So I think we'll continue to see a lot happening in the health, wellness, nutrition space. May also be more of a focus in this, going back to the policy discussion in this current administration. But putting that aside, I think we're seeing the uptake on consumers.
Really interesting. And I've heard of GLP-1s also called a sleep apnea drug, or they're being tested for different indications, including sleep apnea, because weight gain can contribute to sleep apnea, so weight loss could contribute to resolution of sleep apnea. And also GLP-1s as a longevity drug, because when you start getting to be age 50, 60, 70, it's really helpful to be thin when you start hitting those ages. So really interesting potential around GLP-1. So are there any kind of areas where you think there's going to be increased spending because of Trump or RFK policies? So it's easy to talk about them stopping something, cutting something, reevaluating something. But are there areas where we think that there might be increased spending? So, of course, Obama increased spending enormously on EMRs, and there have been other areas where a president has focused on certain things, which has driven regulation either by mandate or by spending, has driven investor interest. Have any of these popped up to you that you've seen from Trump or RFK in the world of digital health?
Well, I think we'll have a facilitative and supportive environment for AI and technology and for startups. And so we're seeing that, the AI czar, David Sachs. So David's working on these kind of issues. How do we create more innovation and a more facilitative environment? Dr. Oz has spoken a little bit to this. How do we create more innovation? How do we free up some of this data? This is also something under the Biden administration that was done too with the 21st Century Cures Act in terms of how do we expose more information, and under the first Trump administration with some of the transparency data on pricing with health systems and others. So I think while those may create some challenges for incumbents, sometimes they create tremendous opportunities for the insurgents with more data transparency, with more startups, with more data liquidity. These in general are good things. We have to make sure we do these in a safe way and protect people's information and data. But in general, we want more innovation, more entrants, not less in healthcare. So I think in general, those things are good tailwinds for innovators. There may be more push towards health and diet and nutrition and precision nutrition and some of the things that we were just speaking about in this administration. And, we'll see what other kind of innovative approaches could come out of CMS or the Center for Medicare and Medicaid Innovation. Certainly looking for a more consumer oriented and market oriented and technology oriented solutions there as well.
That's interesting. So I hadn't thought of that, but there has long been a robust community around consumerism in healthcare, around things like diet, exercise. And at the very least, that's going to get a kind of a profile and publicity lift because RFK is literally, campaigned on and plans to push initiatives around healthier food and perhaps also tracking and documenting and inputting that healthier food into a system so that can expect a sort of a publicity lift for wider consumer interest and use of these kinds of consumer health apps on the iPhone. Really interesting. I've heard, by the way, that the newest fad diet is to print out an angry photo of RFK and put it in your pantry so that so that whenever you get the munchies, you go there and you've got him telling you, lay off the extra calories. So, and then also, I think that the Biden administration, it was concerned about AI safety, and that led it to want to kind of recognize the early innovators in AI foundational models, which would obviously be OpenAI, also Google, also Anthropic Claude, also the others, and then build regulations around that environment so that those foundational models could be sort of controlled better. And so that was good for those new incumbents and not good for challengers who want to try something brand new. And the Trump administration and David Sachs, they seem to be very much strongly supportive of removing restrictive regulations and opening the field up. So you get new companies come in. There's famously DeepSeek, the Chinese model, was a high performance model that has since entered the scene. And also there's also Open Evidence, which is a Boston based healthcare only foundational AI model that only takes in the highest quality, peer reviewed journal type information in order to be able to provide better, more vetted answers to healthcare professionals who ask it questions. So there's more room for that kind of innovation, which could even include brand new teams that haven't started yet, but that are getting funding and putting together an idea for a foundational model that might have been blocked off in the past because of the idea of restricting major AI foundational models to the early incumbents for that. So those are two interesting areas.
Yeah, I do think we're going to see support for innovation here and new models. I'm not sure we would have seen restrictions to just those models. I think the question was around validation testing, and I'm involved with something called the Coalition for Health AI, which had some involvement with big industry and startups. And basically the question, and under the last administration, the question was, how do we know if these models work? How do we know what data they're trained on? How do we know if they're trained on inclusive data? How do we know if there's drift in these models over time? I think what we're going for is, rather than have a regulatory approach, which was going to, frankly, at the end of the day, still require the users to evaluate, I think it stays with that. The government's not going to be able to keep up with the change. And we want to protect the end users, but we also don't want to stifle the innovation and necessarily lock in certain incumbents in the innovation. And so we're invested, for example, in a company called Qualified Health that is kind of a software infrastructure layer that right now is working with health systems. It's almost like a business intelligence tool. It sits on top of EHR data, and then health systems can build apps, if you will, generative AI apps, review these charts, look at the structured, unstructured data, tell me this, that, or the other. But what it's also doing is it can track these models, and it can track which data was it pulling, where did it pull it. It can run simulations, pull it on people 26-year-old, 27, 28, male, female. Did it give you the same or different results? Did the result change over time? You could turn on and off the provisioning of these models within your health system. So I think what we're going to be evolving to is this kind of tooling, so organizations can validate these tools. And you may have nonprofits and coalitions like CHAI and others saying, hey, here's some stamps of validation or evaluation. You might even have some laboratories that are validating these things. There was some thought that should be required. I think now that'll be more of, hey, it's up to the user how you validate these things, because it's kind of like I said, a website, everything going to have AI in it. Every email you send is doing autofill, right? So where do you draw the line on these things? Ultimately, it's going to be the healthcare organizations and the end users that are going to have to still protect the safety of their patients, their clients, their users, and think about these things. So I think you'll see tools like Qualified Health, kind of almost like cybersecurity tools, right? They're going to monitor, they're going to track, they're going to evaluate, even as they allow you to build tools. And I think the kind of if you will, the best companies are certainly the ones that are going to want to get big enterprise traction. They're going to have to be HIPAA and SOC 2 and BAA, and they'll probably have some other certifications, whether they're formally certified or not. If you're a big health system or a health plan and you're going to implement this tool, you want to make sure that it's protecting your data and your members or patients' data. So I think we're going to see that, but we'll see that from kind of the innovative sector.
Really interesting. And on Tuesday, I'm going to be the host of a debate on will AI replace your doctor? And I've actually hosted this kind of debate several times in the past. This is just, the context keeps changing. And one of the better answers I've heard is that we will always have doctors because we need a human to take responsibility. That's actually one of the core roles of a doctor, is to be a human who takes responsibilities. You got all kinds of information from different sources, but that doctor has a relationship with the patient, knows this elder patient doesn't like aggressive therapy, and then the doctor has to take responsibility. And so with AI, you could have AI might be better at certain functions than a doctor, certainly better at memorizing things than a doctor, better at keeping up with the literature than a doctor, better at making an analysis than a doctor, but the doctor remains responsible. And so if AI makes a mistake, which we often tend to focus on, could AI possibly make a mistake? It's the doctor's role to sort of ideally prevent the mistake from mattering, but also the doctor is then responsible for having used AI that was capable of mistakes and modulating over time towards AI that was better. Humans also make mistakes. I think we'll still have, as AI gets involved in every product in healthcare, we'll still have humans and doctors involved, because we need a human to take responsibility and also to choose between conflicting goods and to choose between conflicting nearly equally good paths. Anyway, I think that's I don't know. Do you have a thought on the question, which I think was raised most memorably by Vinod Khosla about 15 years ago, of whether AI will replace your doctor?
Yeah, and I happened to be on a panel with Vinod just a few weeks ago, and when I was CEO at Stanford, he and I would catch up. We were just up the road from each other, and I remember when he made that statement and we were engaging. I think it's almost a false dichotomy. If I'd asked you, I guess I could ask you, unless you're a One Medical member, how easy is it for you to get access to care? Can you get it in a few minutes? Can you get it in an hour? Average time to a primary care appointment in the US with insurance is something like 26 days. Not at One Medical, by the way. So you're probably searching already somewhere. Isn't that AI? I mean, before it was search, and now maybe there'll be AI. So you're already engaging with that. Now, if you're a clinician, are you reviewing the chart in advance? Did you review my genomics, my proteomics, my metabolomics in advance of the appointment? Did I, as the patient, tell you all that? How could I? Did you review my longitudinal continuous wearing data? How could you? I mean, that's going to have to be processed by data, right? And so do I think the human touch and care and compassion matter? Absolutely. Do I think, back to your point about voice, some things are nonverbal. right? Some cues are nonverbal, right? Now you could do computer vision, you could do a bunch of other things. Do I think the human experience is important? Absolutely. But we're absolutely going to be using AI and technology. Your clinicians are. There's not enough of them. You can't get in. There are no appointments. They're not available. And when they are, we really need them to focus on the right issues. And these other things, you probably don't need them to do for you. And certainly there's interventional care that, even robotic assisted surgery still needs some humans with the robots. It's a definite and it's already here.
Interesting. And so there's also a distinction between, you mentioned, do you have access to clinicians or not have access, or maybe access only in 26 days? There's also a rich country, poor country issue here, which is that in America, we love the idea that, if you're older and you have cause to have an electrocardiogram, then that'll be evaluated by a specialist, and then that specialist will write a report and give it to your primary care physician. In a poor country, you may have a choice between just an automated device or nothing. And so we may see versions of these that cut out specialists for a lower income country. So for our audience, by the way, now's a chance to ask any last questions as we approach the half hour mark. But let me get to a last topic, which is if you were in the innovation community, 15 years ago or so, there was a very strong bias then toward investing in software business models. So software business models take a big fundraise up front to build the whole product and then build the whole sales force and then sell it. But if it was a hit product, then you could scale rapidly with very high margins, and that made it all worth it. And so, but more recently, especially in healthcare, we've seen some investors sort of prefer the tech-enabled services model. So in the past, investors might not have liked services models. You don't need to raise as much money usually, but then they also don't scale as fast, and they don't have as high margins in general as software businesses do. But today, in the last few years in digital health, we've seen a lot of investors look anew and more positively at tech-enabled services companies in healthcare. Maybe they have more market power than just software companies or other reasons. And I think you actually ran a tech-enabled service. I would put One Medical in that group. I'd also put Teladoc in that group. I'd also put Uber in that group, Uber not being a healthcare company. What do you think of this trend toward a growing number of investors being more positive on tech-enabled services, even though it doesn't quite have those sexy aspects of a software business of potentially scaling extremely rapidly with very high margins? But what do you think of, and why healthcare in particular are we seeing this, do you think?
Yeah, I think all of the above can be interesting and can be powerful. I think less about per se is it tech-enabled services or services or pure tech, even though those have some relevant dynamics in terms of cash needs, capital needs, approaches to distribution, input costs, they differ. And back to our initial macro discussion, in a low interest environment, putting dollars into infrastructure, it costs less than it does in a higher interest environment, right? So some of this can move a little bit with macro, but ultimately I go back to the problem statements. What are the problem statements we're trying to solve? If you're trying to automate a call center with AI agents, that's tech. That's like Hyro. Or if you're trying to automate clinical research, we're doing that in MetaLoop. But if you're trying to care for serious mental illness patients post-discharge with schizophrenia and psychosis, that's a combination in our company, MI Health, or in Octave in telebehavioral health. So I think it depends on the problem statement. It depends on the area. To your other point, eventually you may need to navigate somebody to somewhere. And by the way, there's not a lot of those somewheres left, right? It's hard to get in. So there may be a lot of value if you can be the somewhere, and you could do that in the right way. And the somewhere can be virtual, it could be in person, it could be a combination. It may be pure technology, it may be the avatar. It's likely to be a combination of things depending on what the topic is. So I don't think it's an either or. I think ultimately it's understanding one's business model, right? And I think the best companies, the ones that will sustain and succeed, understand their economic model, understand how to distribute, can execute consistently at scale. They'll need an investor base that understands what are the inputs and what are the economics and what's the time frame that's needed to reach that. And sometimes these different models need different investors. And in a zero interest rate environment, we had all kinds of investors coming in which maybe didn't fully understand what they were investing in. But again, if you look at some of the larger public healthcare companies that have been extremely successful, you see hospital companies and ambulatory surgery companies. You see growth in cancer care, right? You see growth in clinics in Optum care, right? And those may take more capital. They may have maybe smaller gross margins, but higher gross dollars, right? And higher dollars. So it depends on the business, the economic model. And I think one can see success across different models.
Great. Well, thank you very much. It's great to have you with us, and appreciate your insights into the changing investor landscape.
Stephen, it was a pleasure being with you and the audience. Thanks everybody for joining. We'll see you next time.
So you've been listening to Digital Health Investor Talk with host Steve Wardell, and our thanks to our guest Amir Dan Rubin of Healthier Capital. And we'll be publishing this show as an episode of the Digital Health Investor Talk show. You can subscribe on Apple and Spotify. And for our New York audience, we're hosting a New York Health Innovation Night on Tuesday, April 1st. You can check out stephenwardell.eventbrite.com for the latest on that. So thank you all, and thanks to our live audience as well.